Are financial uncertainties keeping you up at night? With market fluctuations and economic news often sounding alarm bells, it's easy to feel anxious about your investments and overall financial health. But here's the good news. Downturns and volatility can actually present opportunities if approached with the right strategies. Understanding how to navigate these challenges can not only protect your assets, but also position you for potential growth. In this video, discover how to turn uncertainty into advantage with actionable strategies designed to help you thrive even in the most turbulent times. Whether you're a seasoned investor or just starting to think about your financial future, these tips will provide a roadmap to making the most of current market conditions. Before diving into the details, if you find this information valuable, make sure to subscribe to the channel. Hit the like button, share this video with others who might benefit, and leave a comment below with your thoughts or questions. Your engagement helps others find this content and keeps the conversation going. 1. Seize the opportunities. When stock prices drop, it's easy to view it as a sign of doom. However, many investors see market downturns as buying opportunities. Stocks on sale might seem like a reason to panic, but history shows that markets do recover. For instance, the S&P 500, a broad measure of the U.S. stock market, has historically bounced back from downturns, often with significant gains. According to a Wells Fargo study, the average return after a bear market is about 43% over the next 13 months. Investors should consider this period as a chance to acquire quality stocks at discounted prices. However, it's important to avoid the pitfall of the dead cat bounce, where stocks briefly recover before falling again. Patience and a long-term view are crucial. For those considering real estate, lower mortgage rates during downturns can also provide opportunities to secure more favorable loan terms, making it a potentially advantageous time to buy property. 2. Keep emotions in check. During volatile times, emotions can easily cloud judgment. Panic selling is a common reaction when market conditions worsen, but it often results in locking in losses rather than capitalizing on long-term potential. It's essential to stay calm and make decisions based on rational analysis rather than fear. Implementing a structured investment plan and sticking to it can help avoid impulsive decisions. For example, setting predefined rules for when to buy or sell investments can help maintain discipline. This might involve setting stop-loss orders or regularly reviewing and adjusting your portfolio based on long-term goals rather than short-term market movements. 3. Maintain cash reserves. Keeping a portion of your assets in cash is a prudent strategy during uncertain times. While it might be tempting to invest every available dollar, maintaining liquidity provides a safety net and allows you to take advantage of opportunities as they arise. Financial advisors often recommend keeping around 15% to 20% of your portfolio in cash or cash equivalents. This approach ensures that you're not forced to sell investments at a loss to meet immediate needs. Additionally, having cash on hand can help reduce stress and provide flexibility during market downturns, allowing you to make strategic decisions without the pressure of needing to access funds quickly. 4. Ride the roller coaster. Market volatility can feel like a wild ride, but sometimes the best strategy is to ride it out. Dollar-cost averaging is a technique where you invest a fixed amount of money at regular intervals regardless of market conditions. This method helps mitigate the effects of volatility by buying more shares when prices are low and fewer shares when prices are high, ultimately lowering the average cost per share. Long-term investing typically outperforms trying to time the market. For instance, investors who consistently invested in the market over the long term have often seen better returns than those who attempted to time their investments based on market predictions. 5. Protect your career. Economic downturns can pose risks to job security. To safeguard your career, focus on making yourself indispensable to your current employer. Upskill by taking additional courses or certifications relevant to your field, and be proactive in taking on extra projects that demonstrate your value. If you sense that your current company might be in trouble, it might be wise to start exploring other opportunities. Look for companies with a track record of stability and growth, even in challenging times. While it's essential to be cautious about changing jobs, positions with resilient companies can offer stability and growth potential. 6. Strategic selling. If you decide that selling some of your investments is necessary, do so strategically. Avoid panic selling. Instead, Assess which investments are underperforming and consider trimming them from your portfolio. This allows you to rebalance your investments and free up cash for better opportunities. For instance, significant sell-offs by institutional investors, such as Berkshire Hathaway's reduction of its Apple holdings, often reflect strategic adjustments rather than a complete exit from the market. This approach can help in repositioning your portfolio to align with future opportunities. 7. Block out the noise. The media can amplify market volatility, making it seem worse than it is. News cycles and sensational headlines can cause unnecessary stress and lead to poor decision-making. It's important to focus on your long-term goals and not be swayed by every piece of news or market fluctuation. Creating a buffer between your daily media consumption and investment decisions can help maintain a clear perspective. Consider setting up periodic reviews of your investment strategy rather than reacting to daily news updates. 8. Capitalize on the gig economy. The gig economy offers a way to supplement income, especially during economic uncertainty. Freelancing, consulting, or taking on side projects can provide additional financial stability. The gig economy is growing rapidly, with projections suggesting that freelancers will outnumber traditional employees in the near future. Popular gig roles include ride-sharing drivers, freelance writers, graphic designers, and various positions in technology and digital services. Exploring these opportunities can offer additional income streams and help navigate financial uncertainties more effectively. 9. Evaluate your spending. In challenging economic times, reviewing and adjusting your spending habits can be beneficial. Cutting down on non-essential expenses and focusing on saving can help maintain financial stability. Creating a budget and tracking expenditures can identify areas where you can save and reduce financial strain. 10. Consider alternative investments. Diversifying your investment portfolio can help mitigate risk. Alternative investments, such as real estate, precious metals, or even collectibles, can provide additional avenues for growth and stability. These assets often have different risk profiles compared to traditional stocks and bonds, offering a way to balance your portfolio. Economic downturns and market volatility can be daunting, but with the right strategies, they can also present opportunities. By staying informed, making rational decisions, and maintaining a long-term perspective, you can navigate these challenges effectively. With that said, thanks for watching, and until next time. Don't forget to subscribe, like, and share this video to help others gain valuable insights into managing their financial future. Your support makes a difference and ensures that more people can access the information they need.